Spot gold just hit $4,125 an ounce, and the market is buzzing.
You've probably noticed gold's been on a wild ride lately. Up big, down big, and everyone's trying to figure out what's really driving these moves. So today, we're breaking down what major analysts and insiders are saying, and more importantly, what it actually means behind the headlines. Let's start with something interesting from Walter Bloomberg. Walter Bloomberg posted, Goldman Sachs keeps $4,900 gold target for 2026 on strong strategic demand. Now that's a bold call, $4,900 by 2026, but it's not random. When Goldman talks about strategic demand, they're not talking about small traders buying a few coins. They're pointing to deep-pocketed players, central banks, sovereign funds, and large institutions who are shifting capital into gold as part of a long-term hedge against currency risk. It's basically saying the world's smart money isn't just holding gold to play a price swing, they're repositioning their portfolios for a new global order where fiat money keeps losing value. That's why Goldman's not backing down from that $4,900 target. Barchart then posted, gold warrants going parabolic on the Shanghai Futures Exchange. Now this one's really important because when you hear parabolic, it's not just a price term. It means volume and demand are accelerating fast. Shanghai is the heart of Asia's physical gold market. So when warrants, which are claims on real physical gold, start exploding, it means real bars of gold are being locked away. And that's huge. It tells you China isn't just speculating, it's accumulating. They're stockpiling physical gold at an extraordinary rate, which lines up with their long-term plan, reducing exposure to the US dollar and strengthening their own financial system with hard assets. Another post by Walter Bloomberg, Bessent says gold price rising has helped us substantially. Scott Bessent, who's basically a student of Stanley Druckenmiller, is highlighting something we're seeing across many hedge funds. Gold isn't just a defensive asset anymore. It's becoming part of their offensive strategy, a way to actually generate returns, not just protect from inflation. So when someone like Bessent says rising gold prices have helped their portfolio, it confirms that big money is not just watching, they're actively positioned for it. Zero Hedge posted, America's sixth default is coming. What it means for gold and your wealth. Now, Zero Hedge's headlines can sound dramatic, but underneath the tone is a real concern. U.S. debt. When people even start talking about the idea of a U.S. default, it shakes global confidence. And what happens every time that fear rises? Money moves into gold. It's not about panic, it's about security. Investors know that when governments overspend and currencies weaken, hard assets like gold hold real value. That's why every dead scare ends up fueling another round of gold accumulation. Walter Bloomberg also shared, spot gold extends fall, last down more than 2% to $4,304.56 per ounce. Now, here's where a lot of people misunderstand. A 2% drop doesn't mean the rally's over. In fact, in strong bull markets, these pullbacks are normal, even healthy. They wash out the leveraged traders, they cool off sentiment, and they let bigger players re-enter at better prices. So don't see it as weakness, it's like the market taking a deep breath before the next move. The Macro Pulse said, gold could crash to $3,400 very fast. Now, that's a bearish call, and it might sound scary, but it's often based on technical charts, not fundamentals. They're looking at price patterns, maybe short-term overbought signals, but the real driver here, physical demand, doesn't disappear overnight. Central banks are still buying, China's still accumulating, and geopolitical risk isn't going anywhere. So even if we get dips, the floor keeps rising because of that long-term structural demand. Barchart also posted, gold dollar GLD on track for its first red week since August. That's the world's biggest gold ETF. And when it shows a red week, it just means some investors are taking profits. After a string of green weeks, that's natural. But pay attention. If those outflows slow down next week, it could signal that the correction's already over. It's like watching the tide go out before the next big wave rolls in. Peter Spina posted, gold's range this week resembles last week's already, and Wednesday just started. Let the volatility fly high, brace yourself for London's open soon. Now, this is a real trader's insight. Peter's pointing out how the London session tends to shake up gold prices. It's where the heaviest liquidity flows hit the market. When volatility starts building before London opens, it's often a sign big institutions are repositioning or preparing for upcoming data releases. So when he says brace yourself, it's not hype, it's experience. London's open can turn quiet gold markets into a battlefield within minutes.
Rashad Hajiev commented, "Now we are going to see analysts throw figures for gold's correction, 3.5K or even 3K. Wishful thinking." That's such a good observation. He's basically mocking how analysts love to call for massive drops the moment gold dips a little. But historically, gold has rarely crashed in the middle of high physical demand cycles. So Rashad's right, a lot of these lowball targets are just noise. When countries are buying tons of gold and retail demand strong, $3,000 becomes less of a prediction and more of a fantasy. Wall Street Gold posted, "Shanghai's gold warrant explosion shows an extraordinary structural shift. China is aggressively locking up physical gold, possibly the strongest accumulation trend in modern history." And this is the story that could define the next decade. Because what's happening in Shanghai isn't temporary. China's strategy is clear. Move away from paper-based reserves and toward tangible, hard-backed wealth. That's a fundamental shift in global finance. And if this continues, the East could end up controlling a massive portion of the world's physical gold supply, giving them serious leverage in the future of global trade. The great Martis said, "Gold followed the red line to perfection before popping." Thanks for listening. That's a classic technical trader comment, and it shows how the market respects key support levels. When you see gold bounce perfectly off a trend line like that, it tells you that both technicals and fundamentals are in alignment. So when you put all of this together, what are we really seeing? Short-term noise, yes, but underneath it, a deep structural shift. Asia's buying gold at record levels, Western institutions are adding exposure, and the global debt story just keeps getting worse. That's why I believe gold isn't just reacting, it's repositioning. It's slowly reclaiming its place as a true global standard of value. This video is for educational purposes only and not financial advice. All original posts from Walter Bloomberg, Bar Chart, Zero Hedge, Peter Spina, Rashad Hajiev, Wall Street Gold, The Great Martis, and the Macro Pulse are credited to their respective authors. Always do your own research before making investment decisions.